Oil is hovering around $60 a barrel. It could put some companies' dividends at risk if it stays around here, although a handful of producers say they are ready to deal with lower for longer oil prices. Pippa Stevens here with some names to watch. This always makes people a little nervous to start talking about dividend cuts.
That's right, Kelly. And so coming out of the pandemic, energy companies really positioned themselves as prioritizing shareholder returns. But with oil languishing in the low 60s, those hefty payments investors have become accustomed to could be in jeopardy. Last year, the international majors paid out a record $119 billion, according to Rystad, with shareholder returns as a share of corporate cash flow from operations rising to 56%. If this year's buybacks and dividends remain at 2024 levels, that ratio will top 80%, a level the firm called unsustainable. For the time being, the companies, including Exxon, Chevron, BP, and Total Energies, are holding the line. But if oil stays where it is, these payments will become increasingly difficult to maintain. Now, it is a bit of a different story for the U.S. upstream specifically, where we're already seeing spending cuts, with CapEx forecast to fall 8% compared to 2024. The slowdown in production probably won't be felt this year, but will show up in 2026's output levels. Now, as cash gets tighter, one metric that becomes increasingly important is the oil price required to break even and maintain dividends. Diamondback has one of the lowest cost profiles across U.S. shale, according to TD Cowen, with Permian Resources, Devon, and Oxy all below 45. Importantly, though, Kelly, that is for existing wells, not to drill a new well, which is more like $65.
CHRG, EOG, these are some of the names that have a higher break even?
So, yeah. So those are the ones that have the higher, and really it's the Permian Resources, the Diamondback that have those lower levels. But again, that's good for the time being. But if you want to grow your production, which you have to in order to be able to maintain these hefty payouts, you need to drill new wells, and that's about the $65 level. So we're now below that.
And not just that, but aren't people a little sour on the Permian, broadly speaking? I don't know. I hear this talk sometimes in the industry.
Yeah, there's always peak oil. There's also always peak Permian, and the fact that these wells have very high decline rates. And so that just does mean that it's a constant hamster wheel of sorts, in the sense that you always have to keep spending, always looking for that better acreage. That is why we saw that wave of consolidation. It was to secure that things like Exxon and Pioneer, now they can drill 4-mile laterals. And so that puts them at an advantageous position.
Amazing. 4-mile laterals.
Yep, 4 miles.
That's what it takes.
It's a lot of engineering.
Especially with oil where it is. It's hard to make the math work. Pippa, thanks very much. Appreciate it.